Good afternoon, traders and investors. Will back here with another one, coming to you with a Tuesday market recap. Hope all of you had a very good day. And in today's markets, guys, we had a beautiful rally continuation push by the bulls, and a lot of that was due to favorable producer inflation numbers that came in this morning before the bell and really just propelled markets higher the entire day. Now, in today's video, guys, we're going to recap a few things together. Number one, of course, we have to go over that producer inflation report in detail and see whether or not our inflation trends are still moving in the right direction. Second, we have another piece of information that hit the tapes this morning, guys. And this one, I don't think anybody saw this one coming, right? Starbucks replaces CEO with the Chipotle CEO, Brian Nichols. So essentially firing the CEO on the spot this morning and replacing him with one of the veterans in the game, the former now CEO of Chipotle. So we're going to recap this article and what it means for potentially both companies as well. Thereafter, we're going to go into a few earnings reports that I have prepared for you guys. Number one is going to be Home Depot, which came in with earnings before the open today. Number two is going to be Ralph Lauren, which was a ticker requested by one of our subscribers, Nathan. So thank you for that one, Nathan. We'll take a look at Ralph Lauren's earnings. They had earnings roughly about a week ago at this point. And then we're going to cover New Bank, which is one of Warren Buffett's holdings and also a holding by Sequoia Capital, the legendary venture capital fund. So a lot of earnings to cover today, guys. Thereafter, we're going to take a look at our major technical analysis rundown in terms of our major market indexes, then dive into our big tech names and see if there are still some decent deals on the horizon in terms of the buy the dip opportunities. And lastly, conclude with a little bit of my portfolio, see which trades I moved in and out of over the course of the day and how I remain positioned for the remainder of the week. So a lot to cover here today, guys. Let's jump right into the action. So SPY up a healthy 1.64% and the QQQ's up almost 2.5% on the day. Was a very broad market day of performance across many sectors, guys. The entire market pretty much heading to the green. Very nice performance and continued recovery, especially in the names of semiconductors. The bottom half of the market equally performing as well. The only sector that was slightly down on the day was energy. Take a look at the 1 day relative performance here, guys, and you can see that even better. All of our major sectors really in the green today, led of course by technology. To the downside, energy. Where does that leave us on the 1 week, guys? Well, now everything back into the green, looking very good, but still on the longer dated performance, guys, we do still have a lot of damage that was done in the past 3-4 weeks of trading. So a lot of sectors are still in the red on the 1 month relative performance. So that being said, guys, with all that out of the way, before we get into more technical analysis, let us dive into some producer inflation numbers and see exactly what transpired early this morning to give the market such a nice lift. Well, take a look right here, guys. All of the numbers came in much better than expected. Year over year comparables, we were expecting 2.3% inflation on the producer side, coming in at 2.4. And your core number, which is a more widely used metric, was expected to come in at 2.7, now closer to 2.4 as well. So really both of them trending towards the Fed's 2% target for both producers and then consumers. We will get to hear from them tomorrow, of course, when we get that CPI release early on tomorrow morning. So as of now, the macro data this week has proved to be quite good. We just need to follow through here with tomorrow's CPI and some consumer facing data such as retail sales on Thursday and obviously your consumer sentiment report here on the Friday session. So a lot of data for the consumer this week. It should be a very volatile week to say the least, whether that is up or down, guys. Expect some outsized moves in either direction, right? So moving on into the report, guys, you will see here that really it was a tale of one of our stickier elements of inflation coming down. So here's your overall producer inflation trend. You can see that this is on a month over month comparison chart. We're only truly sitting right now at about 0.1, right? 0.1% increase, which is not that much at all. Very stable level of inflation for producers. As a matter of fact, really lower than the prior to the pandemic averages. So looking very good on that metric as a whole. Now, take a look at the breakdown between goods and services. So goods obviously have been fluctuating here between deflationary territory and the higher end of your inflation marks, which were last year in September and again this year in February, right? Really coming in over the expectation. Now, goods have had a slight rebound since the read in May, but nothing truly worrisome in my humble opinion, guys. It will fluctuate here wildly. The important part is that we're within the standards that we had prior to the pandemic, and that still is the case. Goods, for the most part, are in a deflationary cycle cycle right now, so we're not expecting any nasty surprises in terms of price increases. Now, the true tale of the story here today is definitely going to be services. Services clocking a negative 0.2% read for the month of July, which is very, very good, guys. We have not had a negative read since the month of December, and prior to that, since the month of September as well. Looking very, very good. Now well below our pre-pandemic trend as well. And this was one of these stickier elements of inflation that we really wanted to see come down a lot. And so far it has been coming down quite nicely, at least in the past 2 months of data right here. So everything really moving in the right direction, guys. Goods have been deflationary now for about the past 3, 4, 5 months. Services have remained elevated, but we can see that trend finally starting to break. So overall, guys, very satisfied with this report, but as I said, we have to pay special attention to the one that comes out tomorrow, which is arguably more important, and that will be your infamous CPI. So stay tuned for that one specifically. Now, moving on down the headlines, guys, we're going to take a look at this headline from Starbucks and Chipotle. So when that news happened early on this morning, guys, you obviously might have seen what's happened with Starbucks share price since then. They are up 25% on the day. Just goes to show that this company needed at least one piece of good news. And when they finally got that one piece of good news, the share price responded in a very, very wild fashion today. And to the flip side, which I also think nobody saw coming, but Chipotle stock, as a matter of fact, was actually down on the news, down at one point this morning, almost 14%, which was a tremendous buying opportunity. And I will explain why once we're done with the article. So Starbucks replaces CEO Laxman Narasimhan with Chipotle CEO Brian Niccol, one of the veterans in the game here, guys, right? So Starbucks, everybody knows that they've been having a true struggle as of recently. Business declining in North America, across Europe, and the China expansion has been very, very lackluster since starting that one during the pandemic, arguably at a very rough time for the company right now, right? So they really needed certain things to come in line to start turning around the company. And who better to do it than one of the veterans in the game, Brian Niccol, who turned around Chipotle's brand in 2018. He is no stranger to quick service restaurants, guys. Before that, he brought Pizza Hut back from the depths of pretty much brand sentiment, right? The sentiment around Pizza Hut was very, very bad at one point, roughly about 10, 12 years ago, turned that around. Then he moved on to Taco Bell and did the exact same thing to finally come to Chipotle and turn around that brand as well. So really, in terms of quick service restaurants, guys, arguably, there is no better person in the game to start a brand turnaround than Brian Niccol, which is why the company was pretty much headhunting for him. Let's jump into the article here. So, talking about the current Starbucks CEO, is he bad or was he bad? Well, keep in mind, he's only been in place, guys, since 2023, barely a year of tenure at the company. But the CEO of Starbucks was also a veteran in the game, but not specifically to quick service restaurants. And I think that is where the argument lies for the replacement. So before joining Starbucks, Narasimhan was chief executive of Reckitt, which owns brands like Lysol and Mucinex. So you can see his expertise, guys, is definitely not as deep in terms of quick service restaurants as someone like Brian Niccol. Now, moving on. Here's Brian Niccol's resume. As CEO of Chipotle, he helped the chain rebound from its foodborne illness scandal and led the restaurants through the pandemic. In recent quarters, while other restaurants have reported a sharp pullback in consumer spending, Chipotle has seen its traffic and sales climb, bucking the trend. That we definitely know after covering their earnings on the channel. So here is what the CFO of Starbucks had to say about the matter. We thought we had the opportunity to engage with one of the biggest names in the industry, someone whose track record is just clearly proven, not only through the spectacular results that he's had at Chipotle, but also before that at Pizza Hut and Taco Bell. He knows the industry, and we thought he would be the right leader for this moment. So in terms of the CEO swap, guys, it's just a question of fit. And when we move on lower, you will see that Starbucks actually does acknowledge that the former CEO did make some progress in the business. But in times like this, guys, when the brand is really getting crunched, when you have activist investors pushing for change at the company as well, you really need to have the right fit leading the company. And that is why I do think they made the change. Now, the CFO acknowledged that the former CEO, Narasimhan, faced some challenges coming into Starbucks without restaurant experience, but added that he helped decrease turnover and address supply chain issues. However, it appears that the board has more confidence that Niccol will be able to turn around the business quickly. Keyword quickly, right? So, one of Chipotle's strengths under nickel has been its app, which has helped fuel its strong performance in recent quarters. Starbucks' app has been one of the scapegoats of its weak performance. Schultz, the former Starbucks CEO for the past, 10, 15 years prior to the most recent CEO, and other Starbucks critics have pointed to the glut in mobile orders, which slows down service and hurts the customer experience. So that is the moral of the story for the article, guys. Once again, as I've said, I truly do believe that it's a question of fit. Nothing more, nothing less. Brian Nichols is just better suited to the task at hand right now, and arguably, he is the best chance for Starbucks to get the brand turnaround happening quickly, right? There's no doubt in my mind that the former management team at Starbucks would have been able to get the job done, but in terms of time and effectiveness, probably Brian Nichols is going to be a better pick for the company, which is exactly why they chose to do that. Now, in terms of the stock prices relative performance, guys, especially in terms of Chipotle's, right? Chipotle down 14% off of that news. Let me just get one thing out there right away, right? Chipotle at this point in time, is a very well-oiled machine. They really don't have to do too much. All of their business model is really set in stone right now. They've optimized a ton of things, automated so many other processes, and their Chipotle Lane, their equivalent to drive-through service, which is actually a pickup service, has been performing very, very well, and their loyalty through their app is also performing very, very well. So essentially right now, the company has no problems. Brian Nichols is leaving them a well-oiled company that doesn't really need that much fine-tuning. He has done most of the work. So his departure, guys, which translated into a 14% stock drop, I do not believe that that drop is warranted at all. I don't really think it's going to change much at Chipotle, to be quite honest with you. Anybody who replaces Nichols basically has a company that's running on autopilot. Yes, they will still have to be diligent in cost control and customer satisfaction metrics, but still, for the majority of the business, guys, it's relatively on autopilot right now on a very nice expansion trajectory. Now, in terms of Starbucks, well, is it Starbucks a good buy up here at 95, guys? It's very tough to buy the company up here, right? Because the company still has the exact same problems as it did back down here in the mid 70s, except now we have to pay 25% more for it. So I would not be opposed to starting on a position on Starbucks, guys, but we need to at least wait for a little bit of retracement, at least below 90. If we can find 90 to 85, might be due to give this one a little bit more chance. But right now, chasing this one up here, when the only news that we have is a change of CEO, I mean, the CEO can be one of the GOATs of the entire industry, and still, it will take them a few quarters to change the business around and get it back on track, right? So Starbucks, for me, still a hold. It was, I assume, a decent buy for a long-term portfolio down here. But right now, the last thing that we should be doing is chasing this stock when they really haven't changed anything fundamentally just yet. So that's pretty much everything for the Starbucks and Chipotle news. Hopefully you guys enjoyed that. Now let's jump right into some earnings, and I have some good ones for you guys today. So number one is going to be Home Depot. So Home Depot, obviously, guys, was leading into the quarter with already reduced guidance. We know why, because consumer discretionary spending is down, and especially with high interest rates, you can't really expect consumers to be itching to do large-scale home renovations that may need financing, right? Consumers' budgets are strained a little bit, and with high interest rates, it's just not the best thing for them to do right now. So all of that leading into this, guys, we were not expecting tremendously fantastic reports from Home Depot. And that's exactly what we got, guys. We got a very, very bland earnings report from them. It showed continued weakness, but the company had already guided down for this weakness. So really no change in our perspective of the company right now. Let's go over a few of their numbers. They did manage to beat EPS by about 3% and managed to beat revenue by about 1.5% as well on lowered guidance. So they already lowered their targets in order for them to possibly be able to beat them. So just keep that in mind. Let's jump into the article. Home Depot expects sales to weaken as consumers grow more cautious. You could replace this company, this name right here, by so many others. You could replace this with Starbucks, with McDonald's, with Walmart, with so many other different companies. We've seen this headline time and time again over the past 3 months. So nothing new there at all, guys. We know what we're getting into, right? Home Depot on Tuesday topped quarterly expectations, but cautioned that sales will be weaker than expected in the back half of the year as high interest rates and consumer uncertainty dampen demand. So the home improvement retailer said it now expects full year comparable sales to decline by 3 to 4%, Now, the guidance prior to that, guys, was a decline of about 1%. So their guidance was already poor, and now they're unfortunately guiding for even lower declines of 3 to 4% instead of only 1%. Now, here's what the CFO had to say about this. Home Depot has contended with consumers who have a deferral mindset. We covered this last quarterly earnings for them. Since the middle of 2023, interest rates have caused them to put off buying and selling homes and borrowing money for bigger projects, such as a kitchen renovation. Yet, over the past quarter, he says surveys of customers and home professionals like contractors have captured another challenge, a more cautious consumer. Now, pros tell us that for the first time, their customers aren't just deferring because of higher financing costs. That was what we were saying the last few quarters about Home Depot, guys. Consumers are pushing back renovations for when interest rates come down. It just makes sense, right? But now they're doing more than that. They are deferring because of a sense of greater uncertainty in the economy. That we have not heard so far. So now you have two reasons for the deferral: economic uncertainty and high interest rates. Definitely not very good for the short term of the company. We all know Home Depot is a legacy brand. It's not going anywhere, but it is a cyclical company, right? When the economy slows down, sales at Home Depot slows down. When the economy picks back up, sales at Home Depot start booming once again. Very cyclical business, but very solid business nonetheless. Compared with many other retailers, Home Depot has a more financially stable customer base. About half of its sales come from its home professionals, and about half come from do-it-yourself customers. Yet, Home Depot still felt the impact of consumer uncertainty. Home Depot's net income for the fiscal second quarter decreased to $4.56 billion, down from $4.66 billion in the year ago prior. So once again, declining revenues. Comparable sales as well dropped 3.3% in the quarter across the business and declined 3.6% in the US. That was worse than the 2.1% decrease that analysts expected. So missing, unfortunately, on those comparable sales and also on the future guidance of revenue, down now declines of 3 to 4% from a decline of 1%. So negative guidance across the board. Shoppers visited Home Depot stores and its website less frequently and spent less when they did during the quarter compared to the year ago period. Customer transactions fell nearly 2%, and the average ticket dropped from slightly to about $89 from about $90, so less than a 1% drop on average ticket and nearly 2% in average or total transactions. So they're getting really hit at every single point. What our customers tell their pros is, they're contractors. Everything I read tells me interest rates will be lower in 3 to 6 months. Why would I borrow to finance the project now rather than wait just a few months? Makes complete sense in my humble opinion. And as you can see, the results of Home Depot getting squeezed where it hurts the most, right? In the margins because of lower sales. So take a look at your gross margin. Unfortunately, since the pandemic, gross margins have been roughly falling off as Home Depot has to contend with higher prices of goods, but not able to increase its own prices to customers, or they just crush their demand. So when you see gross margins falling like this, guys, it is a symbol of loss of purchasing power. Now, their operating margins as well over the last year have been compressing ever so slightly. They've been compensating here. How you maintain high operating margins, guys, is cutting back on sales, general, and administrative expenses. So they've been doing a great job in controlling the expenses that they can control, but the gross margins, that's pretty much revenues minus cost of goods sold, the cost that it costs you to acquire the inventory. So obviously when inventory prices go up because of supply chain issues and because commodity prices such as wood go up, well, you get squeezed at the top line margins. At least they were able to offset that by controlling some of their operating expenses, right? But still operating expenses now at a decline, which leads to a total decline in total net margins since the peak of 2023. So they are getting compressed, guys. They're not dying, but they're definitely getting compressed to a level where it starts to hurt. Now, in terms of Home Depot, guys, in terms of their financials, Home Depot, have to say it is a very, very strong company, right? So moving on into the financials, you will see here that yes, they do run a decent amount of debt. It's just the nature of the business that they run, but they do bring in a lot of free cash flow per year, guys. And even with their margin compression, their free cash flow generation is quite excellent, if I do say so myself. Not that much cash and cash equivalents on the balance sheet, however. So the balance sheet, in my opinion, gets a B minus, right? It's not as solid as something like a Microsoft, but it's definitely not terrible, right? So moving on down in terms of their forecasts here for net EPS expansion and revenue expansion, you can see 2024, a little bit of a slow year into 2025 as well, but 2026, 2027 should be resuming that uptrend in EPS, and revenue pretty much the same thing, right? It has been relatively flat over the last 2 years, should be getting better into 2025 when those interest rates finally start coming down. So all in all for Home Depot here, guys, right? Fairly good stock at a decent valuation, in my humble opinion. Let's take a look at some of the numbers real quick. So their forward PE at $348 right now is about a 22.7. Now, I derive the PEG ratio just because we do it for every company, but when you have a company only growing revenue at 3% per year and EPS at 6% per year, the PEG ratio is not the best, guys. Usually you want to see, to be able to run a PEG ratio, usually you want to see above 10% per year EPS growth, and Home Depot doesn't have it. So you get a very high PEG, but it's normal. It's just the nature of that business, right? A better metric is free cash flow yield, and that is absolutely amazing at 5.1%. Usually most companies always trade between 3.5% to 5% free cash flow yield. Anything above 5% is a very good deal in the market. And Home Depot at 5.1% free cash flow yield is quite a decent deal, if I have to say so myself. Now, in terms of their share outstandings, what do they do with all that juicy free cash flow that they bring in? Well, they buy back a lot of shares. Take a look at their shares outstanding. They've pretty much almost, right? They've cut them almost in half. I would say about 45% in the last 15 years. So they do buy back a tremendous amount of shares. Now, taking a look at that free cash flow expansion as well, they've never really had a problem expanding free cash flow. So very, very solid quarter for them. Again, in free cash flow generation, this one bringing in just above $4 billion in free cash flow. So really nothing bad to say about the company as a whole. And you can see their PE ratio, in terms of historical PE ratio averages, they're at the higher end of the spectrum right now, but that's normal, right? EPS is getting slightly compressed and the share price is remaining roughly the same. So that's why you see a little bit of PE ratio expansion. But as a whole, guys, I do like this company. Nothing truly bad about this company as a whole. Right, they are opening 12 new stores across the year, so they are still expanding their business ventures. That's pretty much all the highlights that we have for Home Depot. Just a very solid business. The area that I would like to pick it up in more myself is this beautiful box range that I derived right here, right? Big previous resistance for the markets, resistance again, and now that we're above it, you can see it's acted as support. If we can get a little bit of a dip on Home Depot down below here, 335 to about 310, I would be tempted to make a little bit of a swing trade opportunity on this one. As of right now, though, guys, just because of consumer uncertainty, I would be a little bit more patient and trying to get the greediest prices possible. So I'm going to wait for that 335 down to 310 to make any further swing trades on Home Depot. Now, moving on down here, guys, our earnings number 2 is going to be Ralph Lauren. So Ralph Lauren had earnings, as a matter of fact, last Wednesday, and actually they had a fairly good quarter. But this stock as well, guys, is in the consumer discretionary segment and has been posting somewhat cautious guidance. So let's take a look at the numbers right here. EPS beat by about 9% and the revenue is up by about 1.4%. But we know when it comes to consumer discretionary stocks, guys, Wall Street does not care about the quarter you just had. It only cares about the quarters of guidance moving forward into a potential further consumer slowdown. So let's look into Ralph Lauren right here. Ralph Lauren CEO, consumers are battling headwinds, but higher end shoppers remain resilient. It is true that Ralph Lauren traditionally caters to a more upscale client, so they could be having a bit of, consumer retention there, such as other brands like Louis Vuitton do have too, right? So the company bucked the degree of soft results seen at rivals such as Levi's, Lululemon, Nike, and VFC amid consumer pullback in discretionary spending. Ralph Lauren's more refined assortment of high-end styles drove consumers into its stores globally, particularly in Europe, Japan, and China. Sales lift from Ralph Lauren outfitting the U.S. Olympics team and other events like the U.S. Open also aided performance. Now, here's what the CEO had to say. I think it's pretty clear whether you look at the overall, wherever you look, that the overall consumer is being pressured by the cumulative effect of inflationary pressures and interest rates. So we're getting acknowledgement from that from everybody at this point. As far as our core consumer is concerned, we actually find them to be very resilient. So bucking the trend indeed. Where the company saw a downturn was in its North American business. Ralph Lauren continues to contend with dual headwinds of exiting underperformance department store locations and more cautious U.S. shoppers. In North America, the company's wholesale sales fell 13%, while e-commerce sales dropped 4%. Wholesale sales is very simple, guys. Take a big retailer store like Macy's, right? Macy's obviously has a bunch of different clothing brands inside of it, and one of them is Ralph Lauren. So when they talk about wholesale sales, it's how much can Ralph Lauren offload its inventory to big name chain stores such as Macy's, right? So wholesale sales fell 13%, while e-commerce sales dropped 4%. Comparable sales at its physical stores increased 3%. So at the actual Ralph Lauren stores, sales were better, but online and through wholesaler retailing, unfortunately, those were down. So we've basically guided that this year we'll close about 45 doors in total. I think over the next 2 to 3 years, we'll probably close 150 doors. So you can see, guys, this company is proactively managing its costs. It is shutting down unprofitable locations and favoring the ones in high traffic, profitable areas more because it sees the writing on the wall. If you do not do cost control when the consumer is weak, well then do not expect your free cash flow and margins to be protected if the slowdown gets more accentuated. So at least we have some good management from that aspect. Now, in terms of the numbers here, guys, you can see it even better. North America revenue down 4%. That was kind of offset by their European revenue up 6%. You can see, right? Very mixed market segments. North America is in the lead, but not by much. So these gains in the other markets, Europe and Asia at 4%, do offset the North American revenue decline. Now, adjusted gross margins, this is very good. They're expanding margins while closing down stores as well. So this is very, very good, keeping their costs under control. Forward guidance as well. Well, here we go, guys. Q1 inventory was down 13%. That is very, very good for them. The last thing that you want, especially when running a fashion brand amidst consumer slowdowns, is being hit with excess inventory of stale fashion trends of last year. That is the last thing that you want. Ask Nike how well that went for them from 2022 to 2023. You can just check their stock price, right? So full year fiscal guidance, constant currency sales, expecting a forward outlook of about 2% growth in sales. Decent, but obviously not the regular 6, 7, 8% that you're used to seeing the brand seeing in normal times. And operating profit margins up 100 to 120 basis points. This is good, just shows you that they are doing a good job at controlling those miscellaneous operating expenses, not spending too much money on those, and controlling costs while the consumer slows down. So all in all, decent report by them and decent guidance as well. And I found this little tidbit here in their earnings report, because I do, even though I don't show you guys this entire stuff, guys, I really do go through them. I'm not saying I read them line by line, but I look for the most important elements and I try to bring them to you guys as best as possible. So here is one thing that I found very, very interesting. Elevate and energize our lifestyle brand drove continued momentum in new customer acquisition and loyalty with 1.3 million new consumers in our direct-to-consumer business online. And how are they getting people to come online? Growth in NPS scores and more than 60 million social media followers, a low teens increase to last year. So this brand understands that in the modern day, you have to use social media to funnel customers to your brand. So nice to see that they're putting an emphasis on that in their earnings report. I do not see enough companies do this. Nice to see that Ralph Lauren is actually acknowledging and giving metrics to their social media engagement. Very, very welcome for them. Operating income as well was 216 million. Operating margin up 14.3%. As we saw, that is very, very good for the company. And now for further guidance for fiscal 2025, the company continues to expect revenues to increase approximately low single digits, centering around 2 to 3%, which reiterates what the article was saying. Just in case you guys don't like the articles, well, you can read it from their actual earnings report. That's pretty much everything for Ralph Lauren that I had for you in terms of the article. Now let's move into a little bit of valuation around the company, right? So obviously, we know that this is a fashion brand more catering to the high-end consumer. But question, right? For anybody who's interested in investing in this company, right? Number one is be very, very careful with retailers in this day and age, especially. But number two, what is their moat? Yes, I understand it's a long-term standing clothing brand. It's a household name. But that is not a moat, guys. A moat is a clear competitive advantage that you do better than anybody else in the industry, or you have a commanding market share around the industry. Does Ralph Lauren benefit from any of those two things? They do not, which is why their share price, for all intents and purposes, is exactly where it was 10 years ago. You want to see a company that has that in the retail space that has an actual moat? Louis Vuitton. And I can tell you Louis Vuitton is a lot higher than it was back in 2014 because they have over 80 different luxury brands and they are almost a monopoly, guys. They are the largest luxury goods conglomerate in the entire world. Louis Vuitton could buy Ralph Lauren 10 times over if they wanted to. So just keep that in mind when looking for retail companies, guys. You need to have companies with very wide moats because fashion trends change, preferences change, and there's no guarantee that this company, even though they're doing well now, can stand the test of time in the long term. So with that in mind, they are growing revenue 6.3% per year and expanding EPS at 10% per year. And with my introduction to these numbers, guys, I'm not saying there's anything wrong with the company at all, right? But when we're picking, we have to compare them amongst the best in the industry, right? So moving on down, 2024 forward PE at $162 is about a 14.35. Not that bad. And when we divide that by their EPS growth right here, we get a peg of about 1.43. Also not that bad for the company. The company's financials are doing fairly well as well. Take a look right here, excuse me. You'll see not that much debt to have. Financials are very, very good. Balance sheet gets an A from me. Decent amount of cash on the balance sheet. Decent amount of free cash flow per year. Nothing wrong to say there. In terms of their forecasts, EPS will be streamlined to the upside over the next 4 years, and revenue will be expanding to the upside as well. So no problems to speak of in the business as a whole. Now take a look at their overall free cash flow, and here's one of the problems, guys. They are generating roughly the same amounts of free cash flow today as they were in 10 years prior. You can see this is not free cash flow expansion. If anything, it's just maintaining. You cannot increase EPS and do buybacks if you are not increasing cash flow every single year. This is the one point of contention that I have with this company. Number two, in terms of profit margins are expanding nicely. Gross profit margin is as high as it's ever been. Operating margins, although they are recovering from the post-pandemic era, they're not what they were back in 2013 and 2014. So need to get a little bit better there in controlling their operating costs. They're doing a good job of controlling costs of goods sold in terms of prices of their inventories. But when it comes to operating their business, general, administrative, marketing fees need to do a little bit better of a job in terms of that. But I can't blame them for spending on them, especially in this highly competitive landscape right now. And in terms of net margins are back to where pretty much they were in the peak of the former business back in 2013, 2014. So all in all, not too bad in terms of profit margins. And the company does do some buybacks of their shares outstanding, of course. They have bought back roughly 35% of their shares in the last 15 years. So not too bad, even though they don't have even free cash flow, they do a good job of buying back shares with what they have. So truly nothing wrong with this company whatsoever. If I wanted to make a swing trade specifically on this one, now could be a decent time, but just be very wary of the consumer slowdown right now. A better location might be a bit more, having a bit more patience and waiting maybe for the 145, 140 retest of these former peaks right here. Bottom end of the support range of 2013, 2014 could be a more interesting level at a better valuation to be playing this company. But as I said, guys, there's no immediate red flags to Ralph Lauren's business. The only reason that I don't invest in this one for a long swing trades, sure, no problem at all. But investing in it for a long-term portfolio, 5, 10, 15, 20 years, I just can't be as certain that they will be able to maintain their brand and their margins as well as a company like Louis Vuitton. And that is just pure fact. It's really not a question of, bias or preference at that point, right? One company has a moat and the other company just doesn't have a moat. It's just basically what it is. So moving on down, guys, going to cover company number 3 right now. And this is another very nice one. It is going to be New Bank, otherwise known as New Holdings. If you don't know what this company is, guys, it is the fastest growing digital bank in Latin America. So a little bit of context, guys. In Latin America, over the past 15, 20 years, there was a lot of market consolidation into only a few big name banks. And once you get a consolidated market whereby the largest players have somewhat of an oligopoly, right? Only 3-4 participants that control the entire market. Well, they don't really feel a need to innovate and provide customers with more value because they control the entire market. They can do whatever they want and people still come to them. This is when New Bank came into proposition right here offering an entirely digital solution. No branches whatsoever and practically no fees whatsoever, which was extremely well received by many populations across South America, which is why now it is the fastest growing bank and has been the fastest growing bank over the past 3-4 years, destroying market share of the legacy players. So let's take a look at the headlines, or let's take a look at Nubank. You'll see from their homepage, no hidden fees, account maintenance fee, how much it costs to open an account with them, 0. How much does it cost to transfer money? 0. How much does it cost to deposit money, right? 0. And also no fees for setting up an initial card. Very nice for them, right? They're taking a North American style approach. We've seen this over the last 3, 4, 5 years in banking, right? Now we're seeing it finally in Latin America as well. So that's pretty much the business model for New Holdings. In terms of their earnings today, well, they were up nicely in the after hours, about 3.54%. And they absolutely crushed it here, guys. Take a look at this. EPS boost by about 5.52% and a revenue increase by about 11%. Now, this one is obviously owned by Warren Buffett. If you didn't know, he has a very decent stake in the company, about 107 million shares, and he got them at the IPO. He has not sold a single share after the huge IPO decline, and now from the recapture of all those declines, he's not sold a single share, and Sequoia Capital as well. If you guys don't know Sequoia Capital, right? These are some of the founders and later on managing partners of Sequoia and some of their early investments. This is a venture capital fund. They get into companies when they're very young and ride them to maturity. So you can imagine the tremendous gains that this company has had for some of its managing partners. The founder right here, early investor in EA, Oracle, Atari, Apple, and Cisco in the 70s and 80s. Can you imagine the returns there, right? Mike Moritz, 1996 to 2012, early investor, Yahoo, Google, PayPal, LinkedIn, just to name a few, right? Now, Doug Leone, he's your current, slightly former managing partner. He was the one that got into Nubank and ServiceNow. That company absolutely blew up as well. And Ralph Botha, who is your new managing partner, he pioneered the early investments into brands such as Unity, YouTube all the way back in the day, Square, Instagram, and Eventbrite. So, I mean, the resume speaks for itself, right? Very high profile investors in this company as a whole. Let's go have a look. Why? Is there something here that they know that we don't? Well, let's have a quick look now, shall we? So, New Holdings reports second quarter earnings. Let's take a look. So, customer growth. New added 5.2 million customers in Q2 of 2024, reaching a total of 104 million customers globally by June 30th, marking a 25% increase year over year. The population of Latin America as a whole, guys, is about 650 million people. So they are aggressively targeting everybody. They still have a decent total addressable market remaining to be achieved, but still they are really scaling this one up excessively fast. Nu has added more customers in the past 12 months than the 5 largest Brazilian incumbents combined, according to central bank data. Engagement and activity rates. Monthly average revenue per active customer reached $11.2 in Q2. The reason that is phenomenal, guys, look how, so this is your revenue per customer, right? $11. Take a look at the monthly active average cost to serve these average customers, right? Only 90 cents. So you can imagine they have tremendously high profit margins when they're bringing in $11.2 per customer, and it costs them only $0.9 to service that customer. Extremely high quality business, high margins because they have no physical locations. It's an entirely digital bank. So moving on down, financial headlights, adjusted net income increased to 563 million. That is an ROE of 33%, guys. The net income margins are 20%. Very tough to find any bank that has 20% margins other than JP Morgan, pretty much. You can see that net margin expansion. Look at this blue line down here. 10, 14, 16, 16 and a half, 15 last quarter, and now all the way up to 20%. Phenomenal margins by this company. Moving on further. Capital. Nu strengthened its position as one of the best capitalized players in the region. Its capital adequacy ratios have very comfortable margins above regulatory minimums in the countries which it operates, even without considering the $2.4 billion in excess cash held by Nu Holdings. So low quality customers and risk of loan defaults is not a problem for them. Not only do they have tremendous amounts of cash, but they're extremely well capitalized in preparation for that already. Now, their cash, right? The amount of capital, you guys might know this from the banks. We've looked at this in the past, right? The banks have two sources of capital that they can use when loans go bad. One is what's called a provisionary fund. The banks set aside a certain amount of dollars every single quarter in the event that they have loan defaults, credit card defaults, and all of that. That is your loan provision department. And then if ever that is not enough, they have to dip into the total company's cash and balance sheet reserves, which right now sit at 2.4 billion. So the company has enough cash in both of those arms of the business in case liquidity is ever a problem for them, which right now it really isn't. Take a look at this earnings report, guys. This is a fantastic, fantastic earnings report if I've ever seen one. So as we saw, right, customers up 21 million customers year over year. 56% of the entire adult population in Brazil are customers of this bank rather. Gross profit up by 88%. Net income up 134% year over year. Absolutely fantastic numbers by this bank, guys. Look at this absolutely tremendous amount of growth in terms of total customers, right? Really over the past 4 years, they have 4x their entire customer base. Extremely popular popular brand, which has momentum rather. So profitability momentum continues. 65% jump in revenues, 48% bump in gross profit margins, 28% in net income gains as well. Fantastic numbers, guys. Strong customer acquisition and sustained growth in activity rate. Very, very, very high customer growth rate. This is total customers, of course. And your activity rate across all customers is going up. So not only are they gaining more customers, but the customers that are using the platform are using it in a more engaging fashion. Now, sustained revenue growth fueled by customer acquisition and avenue revenue per average customer expansion as well. Everything expanding in the right direction. Not going to spend too much time on these. I just want to show you guys how strong of a company this actually is, right? So moving on down. In terms of, let me just want to show you guys a few more ones. So net interest income expansion driven by growth of interest earning portfolio. So obviously they issue loans, they have credit cards as well. Funny thing, New actually put forth its new, the new version of its credit card in the last 2 years. And guess who they are partnered with for that credit card? Because everybody knows that usually banks don't issue their own credit cards. They go through one of the two legacy payment providers, MasterCard or Visa, and this one is affiliated with MasterCard, right? So once again, very, very good. Net interest income is netly on the increase. So very, very nice net interest income increase by them as well. One of the, revenue leaders of the bank, of any bank rather. So you'd need to see this number going up, which it absolutely is. Looking very, very good there. Sustained gross profit growth, ad margin expansion, just going to show that even though they're growing revenues, they're keeping costs relatively low, which is leading to an expansion in margins while the business is growing. You can see that even best in this graph right here. And this is pretty much where we are going to end it. Strong track record of driving operating leverage. The fact of growing revenues faster than you grow costs is what we call operating leverage. If you can grow revenues faster than costs, let's say you grow revenues by 10% per year and costs only grow by 5%, you have 2-to-1 operating leverage, positive operating leverage, of course, right? So as your business scales up, what's known as the efficiency ratio goes down. The efficiency ratio just measures how much of your total revenue are your costs, right? So now you can see the percentage of costs as a percentage of revenue have been coming significantly down, now culminating in only 32%. Very, very good. Flip it on its head, guys. That just means that their operating margins are sitting about 68% right now. So very, very, very solid for them, guys. As a whole, nothing bad to say about the company whatsoever, right? Extremely high quality company, extremely high quality growth everywhere that you want it, right? In every single good metric. Their creditworthiness is also very good. We can go through a few more, but it's just saying that their delinquency ratios are not that bad and they have enough cash to cover it, right? So I don't want to spend a tremendous amount of time on this one. I think that's pretty much enough just so you get a good understanding of where the company is going. Are they on the right trajectory? Now, moving into the valuation here, guys. Well, in terms of the valuation, nothing bad to say about the company. Look at these free cash flow numbers, right? Financials, extremely solid. Almost no debt to speak of. crazy amount of cash on the balance sheet right now, and the free cash flow numbers are absolutely staggering. Would not be surprised if they start using some of that soon for maybe even some share buybacks. Take a look at your EPS growth curve. EPS growth curve is very, very healthy as a byproduct of those very high margins and free cash flow. And revenue also expanding beautifully to the upside as well. Now, in terms of the valuation, here at $13, is it a good buy? Well, $13 may seem like a cheap share price, guys, but you have to remember, right? This is a $61 billion market cap bank. Now, if you want to take a look at one of the other large banks of this one, you just have to look no further than this bank right here. If I can pull up there, let me just pull it up, Banco Itaú. All right, let me just pull it up right there. So this is one of the larger banks in Brazil right now that serves also the rest of Latin America. They have 60 billion market cap. This is actually one of the other largest competitor in all of Latin America right now. And the other one is Banco Santander. And if I just pull up a list of this one is only sitting about $20 billion. So Nu is pretty much one of the largest banks in all of Latin America right now, but they can grow significantly higher in my humble opinion. I would not be surprised if this bank can crack the $100 billion mark just because of how efficient and technologically advanced it is compared to its competitors, right? So moving on down. Revenue growth, 25% per year. EPS growth, 45% per year. Very, very good. Now, that puts them at a P ratio at $13 of about a 31.7. Seems high for a bank, but don't forget the EPS growth rate. When we divide this by their EPS growth rate, we get a PEG ratio of only 0.7. That is absolutely amazing, guys, which does show that the company does have potential profit, to be had to the upside. I would not be surprised if in the next 3 to 4 years, this bank can really come on the verge of that $20 mark. $20 would put them pretty much at a $100 billion valuation. So it may not happen overnight. It may not happen quickly, guys, but I think that it will have this one. So long-term investment, I do like this one. You have some of the largest players in the game right now in the stock. And even in terms of a short-term investment, guys, I like this one a lot too, right? Came down very hard at the sell-off the last 2-3 weeks. Now, after earnings, if we can get a retest of the 12 to 1150 level, guys, classic breakout, retest of the range, and possibly run. You can see that even better on the weekly time frame, right? A little bit of a blip right here, looking to reset this weekly uptrend. So if we can get, guys, and this on the monthly is looking beautiful, monthly uptrend, back testing right now, and possibly looking for that monthly uptrend continuation using your prior all-time highs as some areas of whole support down there. So if we can get a revisit, guys, 12 to 1150 with maybe some overall market slowdown and pull, it can happen and lead into this stock as well, right? That would be a great buying opportunity in my humble opinion for both a long-term investment and a swing trade, not financial advice, of course. So with all that being said, guys, that's pretty much everything we had for our earnings reports today. Hopefully you guys enjoyed that one. Apologies for that. I really needed to. My throat was pretty dry. So let's move on to our technical analysis, shall we? Moving right on into the SPY, and then we're going to cover big tech, of course. So moving on into the SPY, guys. SPY, very nice bounce underway right now. So you're always watching the size of the bounce to be able to determine, do the bulls have enough space to reset the daily uptrend once this move higher finishes, right? So right now, the size of the bounce is looking very, very healthy, guys. Almost a 70% bounce, right? About 72% bounce right now. Very, very healthy bounce for the bulls right now. And now the probabilities have flipped in favor to the bulls. At this point in time, unless we get some really devastating macro data to the downside, guys, I wouldn't be surprised if the bulls are able, once this move tops out, because we are coming into resistance right now, 546 to about 540. This red box above us is resistance. If for whatever reason we lose this move right here and start consolidation, we will just be looking for a higher low for a potential second stab at this resistance level. Looking very good. And obviously, guys, if CPI tomorrow is very good and the market continues its push higher, we might be in a situation where we engulf almost the entirety of this move and be able to reset the daily uptrend from a much higher level. So all in all, the SPY is looking extremely, extremely good right now for the bulls' ability to be able to recapture that daily uptrend, but I would not be chasing the market just yet, guys. Do not feel FOMO. I am going to be patient, waiting for the daily higher low to be formed before making further position attempts. Moving on to the QQQs right now. Same analysis, right? So we had the big daily downtrend culminating into the Black Monday flush, and now we have a very juicy bounce underway. Take a look at the size of the bounce. Size of the bounce now is 78%. Extremely strong bounce, and now the probabilities have flipped. Now the probabilities do favor the bulls' chances at resetting into a daily uptrend. Couple that with the fact that we are now above this area of resistance, 450 down to about 435. We are now above that once more. So in the event we top out here and reset lower, we can use this area as some support to potentially get that daily uptrend underway and start reversing even more of this weekly damage, eventually regaining that weekly uptrend as well. So all in all, very decent price action from the bulls, looking extremely good for the SPY and the QQQs. But just remember, guys, we haven't really lifted any of those recession fears, have we, right? The jobs report from 2 weeks ago, the non-farm payrolls, that still stands. And consumer slowdown, that is also still in effect as well, right? So it's going to be a market that remains data dependent, where even you can get some very, very solid price action here, guys. But if we get a, hotter than expected CPI report and people really don't like it, we could see some very volatile price action. So even though the bulls are favored right now, just be quite cautious in this environment nonetheless. Moving into XLF financials also putting together a very healthy bounce. Same thing, we are just looking for the size of the bounce right now to be able to give the bulls a good chance of resetting into a new daily uptrend. Size of the bounce as of right now is fairly adequate, coming up about 55%. I would like to see one final push into maybe the $43 range, which we could possibly hit. If we can get all the way up there, sets up the bulls nicely to be able to have that daily trend change attempt, creating enough space off of those lows. So financials not looking too bad at all. And even on the weekly here, guys, right? We never really lost the weekly uptrend. We came dangerously close to fracturing the lows, but not quite. This one looks like it just wants to resume its uptrend to the all-time highs pretty much, right? So looking very good. I still remain my favorite plays in financials right now have to be Visa. The reasons I've explained on the channel for the last, 1 month and a half at this point, right? Monthly uptrend, looking for monthly higher lows for further continuation. No problems with Visa's business. And MasterCard, the exact same thing, looking for the continuation of the monthly uptrend. Two of my favorite plays in the financial sector right now. Moving into healthcare right now. So healthcare up about 1.21%. Very good day of recovery for them. And now bucking the daily downtrend completely. Big engulfing move by the bulls right here, looking extremely strong for some short-term follow-through. We are maybe looking for the all-time high breakout at 152 here, guys. The weekly uptrend was also never lost over the past couple of weeks of trading. The higher lows are set right here, 145. So, going to be looking for further trend continuation to the all-time highs. No red flags, and even if we do pull back here, guys, look at the amount of space. Anything above 145, going to be looking for a daily higher low for that, daily trend change attempt by the bulls. Looking very, very strong, if I have to say so myself. Now, moving on to SMH Semiconductors. They were up 4% on the day. Extremely strong day for them. And now benefiting from the continuation of the daily uptrend rally. And we are now almost through this resistance zone, 238 to about 224. This was a big one, guys. Prior weekly all-time high resistance, which was known to be a possible area of contention for the bulls. They blasted all the way through it, and now we're possibly using it as resistance. But we're almost clear, guys, and the daily uptrend is very nice right now. So as soon as this move tops out to the upside, we are just going to be looking for a daily higher low for potential daily trend continuation. What I like about this one is if we get above this big red box, maybe run into this area of resistance right now, 248 to about 255. If we get stopped out right there, could provide us an opportunity to reset the higher lows down into the support box and then maybe have a further attempt for some trend continuation. Looking very good in terms of the size of the weekly bounce, guys. The bulls still have a lot of work to do on this one. The bounce size, not even up to 50% just yet, so not out of the woods. Step number one is complete. They have completed the daily uptrend shift. We are now in weekly recovery mode, and we need to watch the size of this bounce. How you know the weekly bounce is topped out? You will see a loss of the daily uptrend. Lose the daily uptrend, your weekly lower highs are set, and then you are maybe looking for a weekly higher low to be established before gaining the weekly uptrend again. So the long-term bulls still have a lot of work to do, but nice to see that on the daily at least, we have completed some very nice levels in terms of price action. Moving into the Russell right now. So the Russell up about 1.65%, decent day of performance for them, but they've really been stuck here in the last 4 or 5 days of trading. What are we contending with above us right now? Well, this resistance right here, 210 down to about 208. Big prior resistance for the markets and continuing to act as a bit of resistance for the bulls. So one of two things going to happen for sure, guys. Either we're going to get the daily uptrend breakout. That will be a break of 208, break 208 to the upside, you get your daily uptrend breakout, and then we can look to the size of the weekly recapture of this move, because so far the bounce size on the weekly is not the best, right? Only about 38.2% to the upside. So a lot of work left by the bulls, but nice to see them having a nice little start. And if ever the markets roll over because of bad data, we will just be looking for daily downtrend continuation at that point and possible weekly rollover as well, retesting these lows 197 and at possibly the worst point in time for the Russell down the road, maybe even retesting the lower 190 range, which would be a better level for entry in my humble opinion. That is the one that I'm waiting for. I'll be patient. If it doesn't come, perfect, no problem at all. If it does come, perfect, I will be buying. And now lastly, the Dow Jones. Moving on into the Dow Jones, if my screen will load, perfect. So Dow Jones 1.04% to the upside, looking not too bad on the Dow Jones right now. So as a whole, the Dow Jones putting in some decent days of recovery, right? Decent daily uptrend in motion right now. They just set that today by breaking all of these highs in today's price action. So daily uptrend is underway. Keep an eye, we have a small little level of resistance above us. That's going to be your previous all-time high resistance, of course. And in the event we get rejected from there, going to be looking for a daily higher low, anything pretty much above 39,250. Going to be looking for that daily higher low and continuation of the weekly uptrend, or the daily uptrend rather. What are we looking to do, guys? Just looking to continue the weekly uptrend. We never lost the weekly uptrend on the Dow Jones, reacting beautifully from our support zone right here, and now possibly looking to push the highs. If they cannot get it done, guys, the best we can do is possibly a tightening range throughout market uncertainty, and then possibly resuming the uptrend later on after the election cycle, after we get our first few rate cuts. That would usually do good for the Dow Jones. Now, that's pretty much everything for our indexes. Now let's move into our big tech names, shall we? So big tech, Apple up 1.04%. Apple doing a great job here of setting the daily uptrend as well. That's not Apple, that's the Dow Jones. Apple doing a good job of its daily bounce continuation, right? Never even stopping to set up for a daily uptrend. Just completely engulfing the entire Black Monday move. Such a crazy move by Apple. You can see that right here, recapturing, 95% plus of the move, looking very, very good. The next thing, when Apple's move tops out, how do you know that a move is topped out? You will see a net loss in the hourly trend into hourly downtrend. Then you know that daily percent consolidation is underway. At this point, we will just be looking for a daily higher low. Anything above 195 is going to be looking for that daily higher low to potentially get us back into a nice daily uptrend on Apple. So tremendous move by the bulls so far, but I'm not chasing this one, guys. I will wait for a daily higher low to be established to be able to have some better lows, better levels to play off of. If we can maybe come back and retest this 207 right here, that could be a decent level as well, right? Come back test 207 and maybe give us another leg. When we come back, if we get into that 207, you might be able to find some premium down here, 205, 203 for writing short puts. That's the type of setup that I want. In terms of the weekly, Apple bulls are doing a great job in trying to recapture the lost weekly uptrend. Lost the weekly uptrend by losing these lows, and now we are trying to put in as sizable of move as we can to eventually be able to reset this into a nice weekly uptrend. So Apple, one of your lead bulls from your major tech names, them pretty much have been doing a great job, and Meta, I would say, are arguably your two lead bulls of big tech right now. Moving on down to AMD. AMD up a whopping 3.19%. AMD finally breaking above our resistance line, which I labeled on the chart yesterday, which was 137. Finally in a new daily uptrend. So looking very good for AMD. Next area of significant resistance will most likely come at the whole 150, 155 level, all the way up there. So a little bit of runway for the shares yet to come. Now, in terms of if this move tops out tomorrow right away, we'll just be looking for a daily higher low, anything above 128, looking for that daily higher low for continuation of the daily uptrend into this contested 150, 155 zone. That is going to be trying to get as much of this weekly move back as possible, guys. And the reason I want us to pull into this 150, 155 is the size of the weekly move needs to be recaptured, and that recapture level at 150, 155 is about 50%, right? Obviously, we know we lost the weekly uptrend, so now the bulls have to have a big chance at getting it back, and that chance starts with a push to 150 and possibly resetting a bit lower before getting the weekly uptrend back. Obviously, they can just push right through this and reset it higher, but that 150, 155 is going to be our first level. So curious to see how we react from there. Looking very good on AMD. I still love playing this company, guys. At this point, short puts 130 down to about 120. I am all for it. I think the valuation of the company down here is very good. Now, moving into Amazon, give me another quick second. So moving on to Amazon, Amazon up about 2%, looking very, very solid for them, right? Gorgeous continuation of your daily bounce right now, but they have not paused to reset the daily uptrend. So as of now, obviously we know we were in a big daily downtrend, which continued with the earnings and then following into the Black Monday event. So now we have to gauge the size of the retracement, right? Size of the retracement right now is good. We finally got to the 50% mark, which is a good bounce for the bulls. I would like to see them get a little bit higher to really give us the best odds possible at getting back this daily uptrend when we have that consolidation, right? That would be pretty much 175, but nice to see them push back into the 170s. They were literally just in the 150s last week. And I was saying last week, guys, Amazon in the 155s and 160s, a very good opportunity to start buying the dip on this stock. And so far, it's been a very fruitful one as well. Now, moving on down, if Amazon were to top out right here, we would just be looking for a daily higher low. Anything above 152, gonna be looking for that daily higher low setup for the daily uptrend recapture, which leads us into when we get that daily uptrend, we will be looking at how much of this weekly move down can we recapture from the bears as well. So far, the size of the weekly recapture, only about 38.2. You would really need to see them come up at least to 177, at least there to get a 50% bounce on the weekly, to then get the weekly uptrend formation looking good to get back for the bulls, right? So all in all, Amazon, I still love this one, guys, but I will be patient waiting for that daily higher low to give us a more confirmed and local support level to be basing some trades off of. So I will be patient with this one as a whole. In terms of a long-term portfolio, still a decent location to be adding just a couple shares in Amazon. But for swing trades, I'm going to be a little bit more patient, waiting for the daily higher low. And that is when I'm going to be putting a bunch of longs on in terms of call debit spreads and a lot of short puts as well. Moving on into Google right now. So Google up about 1.21% on the day, which was very good. Google actually had a couple of news headlines today. Google actually had their AI investor presentation day, and they launched the first AI-powered Android update and the new Pixel 9 phones. It was a very nice event for them, guys. You can probably watch a quick form recap on YouTube for about 5 minutes, but I really like this one, guys. The conversational awareness of Gemini's AI right now is very, very good. I had my doubts leading into this event. I thought it was going to sound very robotic, very unnatural, and maybe not give you the responses you were looking for. But actually, it sounds like a real conversation. When you ask it questions, when you have a conversation with it, it really sounds like another person. The voice intonation is very good. And also the quality of responses are more natural human responses rather than very robotic and artificial, right? Very good job for them. I highly suggest that you guys watch this. The highlight of this article, however, we're not going to go over the Google, the new Pixel 9, great camera upgrades, great AI features as well. But really the gist, or rather the most important part of this entire presentation was the AI assistant, which everybody knows Apple is working on as well. Google beat them to it, and it was a very good presentation, if I do say so myself. The one thing I want to point out for this presentation is that that service, the live AI service, so conversational awareness with AI, asking it questions and stuff like that, that will not be free. A user can have a human-like conversation through Gemini Live, which the company first announced at its developer conference. Live will initially be available for select devices and subscribers to Google's Gemini Advanced program, which costs $20 per month. So there's the catch, guys. If you want AI on your phone, well, the phone's going to come equipped with the hardware to support AI, but you will have to pay $20 a month for it, guys. Personally myself, I don't use Android. I'm within the Apple ecosystem, but I'm not saying I would use it forever. But if Apple were to charge $20 upfront for similar features, I would probably pay it to try out the service. And then I would probably determine whether or not I need to cancel it or not. But I at least would give it a try, because if it's anything like Google's, guys, Google's was quite good. I was quite impressed, and it takes me a lot to be impressed because I go into these things, with a little bit of hesitation and with a little bit of suspension of disbelief, right? So moving on down to Google's price action. Google's price action today responded well to the event, but as a whole, you guys know Google has been in a daily downtrend, no secret there, and looking for eventually being able to reset this daily higher low into a daily higher high. So far, the size of the bounce is quite decent, not as good as some other ones like Apple, but decent, 50% bounce right now. So in the event that Google falls off from here, going to be looking for a higher low for a potential daily uptrend recapture. Keep in mind, resistance above us right now, 172 up to about 178. That's that big weekly level all the way up here, right? So you can see a lot of damage was done on the weekly. It's going to take them a while to recapture this weekly uptrend as well. In the meantime, though, great location to be adding some Google shares for the long-term portfolio. For some swing trades, I am waiting for a daily higher low pullback myself, just so we can have some levels to base our trades off of, right? Need to wait for that pullback, then we can write short puts below here, and I can maybe even load up on some call debit spreads for some upside in the next 2 to 3 months. All in all, though, Google is looking pretty good right now. Moving into Meta up 2.44%. Meta and Apple, really some of your tech outperformers right now. Look at Meta completely erasing the last few weeks of sell-off very nicely indeed for them. So as soon as this move on Meta tops out, guys, similar to the rest, we're just going to be looking for the daily higher low for further daily uptrend continuation. Anything above 451, just looking for that daily higher low for some potential upside, guys. If we do pull back, probably going to pull back into this level right here, right? 505 to about 500. Big chop zone right here. Would not be surprised for them to set it up right there and maybe get us a daily uptrend into the all-time highs. In terms of the weekly looking very good. The bulls are poised right now and do have the momentum for an all-time high breakout. We are almost there, guys. If we clear the 532 resistance, only one guy left at 542, and then we are off to new all-time highs. So they've done a great job in fully engulfing this weekly move. If they cannot get it done in one clean shot and have to retrace a bit more on the daily, you're just going to be looking for a weekly higher low for then a second push to the all-time highs. Meta looking very gorgeous, if I do say so myself, which is why I was buying a decent amount of it down here. Now moving on to Microsoft. Microsoft also looking very healthy today, 1.77% to the upside, and Microsoft setting up now for the potential daily uptrend reversal too. So Microsoft looking very good in terms of the size of the bounce. Keep in mind, we were in a big daily downtrend on Microsoft, culminating in this last move right here. And now in terms of the size of the bounce, guys, we have recaptured over the 618 mark, almost into the 70% territory. Extremely strong bounce from Microsoft, if I do say so myself. So similar to the other names, guys, the bounce is nice, but eventually we do need to set up into a new daily uptrend to be able to get more lift in terms of weekly rise as well, right? So we need that daily uptrend first. Now, one thing that's good is we've now cleared well above this level of support down here. This green box, 405 roughly, down to about 391. Huge weekly support box. Let me just erase this yellow line because it kind of mixes us up, right? So this green box right here is going to be the last area of support for Microsoft on the weekly. And now we're setting up for potentially the retest of this location as support if we set up for the daily higher low and use 405, 400 as some support for the new daily uptrend. This is where I would look for further positioning in Microsoft. As of right now, if you're a long-term position, I see no problem adding some Microsoft shares at all. But for some swing trades, call debit spreads, and maybe more short puts, I'm going to be looking for a little bit of a pullback on Microsoft, maybe lower to the 405, 400 level so we can load up more, because now we know we've created the space and the likelihood is for the daily trend shift. Moving into Netflix right now, Netflix also with a very juicy bounce underway. Take a look right here. Netflix was in a big daily downtrend this entire time, engulfing the entire move, now potentially looking to set up for the new daily trend change. Netflix is now cleared above our big level of resistance 2, right? So this red box, big prior resistance for the markets, was acting as support. We blasted through it because of the negativity in the last few weeks, and now we are back above. So similar to Microsoft, right? We now can use this level as some support in the event the bulls get tired and have to reset for a daily higher low before getting the daily uptrend back. We now have beautiful support below us. 636 down to about 606. That is going to be the level. So maybe just be looking for a little bit of swing trade attempt, right? Look for the daily higher low. If we can maybe get 620, 615, the stops go below the lows right here. And then we are targeting the previous high expansion. So good risk to reward trade for a medium term swing, in my humble opinion. on Netflix looking very, very good. In terms of the weekly, still have a lot of work to do on the weekly here, guys. We know we've lost the weekly uptrend by flushing these lows all the way down here. So Netflix going to be tough for them to really do a V shape. It's possible, but unlikely. The more likely scenario is possibly the two-step recovery process. Now, moving into NVIDIA. So NVIDIA, very nice day of expansion for them as well. 6.53% to the upside, and daily uptrend is underway on NVIDIA too. So coming into our resistance area right now, 119 down to about 115, could prove to be a little bit challenging for the bulls, but it is NVIDIA, right? We know that on a good day, they can just blast through it as if it's not even here. So we will see what happens in the next few days. One thing is for sure though, since we are in a daily uptrend, if we do get rejected from here, just gonna be looking for a daily higher low. Anything above 98.5 is gonna be looking for that daily higher low for a secondary push into this zone in the event we get topped out right here. And in the event we push through it, then we can start using it as support to then proceed with another daily leg higher, possibly into a pre-earnings push. In terms of the weekly still a little bit of a weekly downtrend right now, but the bulls have so far manifested a very nice bounce even in terms of the weekly. So now it is a 618 bounce on the weekly. So this does favor the bulls for either further V-shaped recovery and even better odds at resetting the weekly, or if they drop from here, they already have good odds at resetting back into a weekly uptrend. One thing's for sure, I'm going to be a little bit patient with NVIDIA. And in the event that we have a little bit of a drop right here, I will be looking to play, once again, short puts anywhere between $100 down to about $95. I really like this area on NVIDIA. It's where we get a lot more price action from the past. So that's why I really like writing short puts down here. Even for something like call debit spreads on NVIDIA, this is the location that I really want to find some opportunities down into. If we can pull back into maybe the mid 108, 107, 106 area, that should free up these trades down here. And this is where I would lead into some call debit spreads for earnings run-ups or some short puts down below here. If we come into here, should open up some premium down in these lower levels. Now moving into Tesla. So Tesla also with a very nice day of upside today and coming into a nice new daily uptrend. So bucking the downtrend that's been in effect over the course of the past month and now into a new daily uptrend. So obviously, as soon as this move is topped out, going to be looking for a daily higher low. Anything above 191, just going to be looking for that daily higher low for continuation of the daily uptrend. Now, keep an eye on resistance levels. The first one happens at 217, and we also have a bunch of moving averages here, guys. 217 all the way up to about 228. This $10 range is going to be a little bit challenging for Tesla. A lot of things going on there. We have the moving averages on the weekly. We have the moving averages on the daily as well. We also have this descending trend line, which is right there at about 220 as well. So a lot of heat in this area right there. We will see if the bulls have it in them to get past it. That being said, on the weekly, guys, all of the momentum, this momentum right here is now completely dead, right? So the best we can probably hope for Tesla, even if the market recovers, is possibly a two-step long-form recovery process in the stock. In terms of how I want to play it, guys, I am still not really touching Tesla right now. In my opinion, they really have done nothing to improve the business in the short term in terms of either forward guidance or concrete steps that management is maybe taking for advertising or maybe new financing terms, right? Like they did the promotions for the 0.99% financing and 1.99% financing on Model Ys just a quarter ago. We don't have anything on that to stimulate demand just yet. So still Tesla's recovery story is in process, but I still think it's a little bit of a ways out right now, which is why I'm going to be patient on this one. I only want to play short puts if I can find them below 180, think 175 down to about 160. Call me conservative, guys, but I'm just not really taking any chances in this market right now because we know, even though we've been up now for about a week and a half, things can reverse very quickly and very hard, right? Now, lastly, moving into Palantir. Palantir, very nice day for them, 3.44%. And they must have, Palantir investors must have watched yesterday's video because I was saying that the best case scenario for them was going to be pushing further above our $30 to $29 pocket. Why is that pocket important, guys? Because it is all of the resistance from 2020 and 2021. So it stands to argue if we can put more space between us and this location right here, we can then probably use it as support for a breakout, retest, and then run pattern on Palantir. Looking very, very good. In the event that the bulls are getting tired here, guys, we might see a little bit of a retracement down here. Would not be surprised if we see some retests of maybe the 28s or mid $27 range. Just going to be looking for a daily higher low, anything above 21, 24, daily higher low for the potential daily uptrend resumption on the stock. This area of congestion right here, guys, 28 to 27, going to be very challenging for the bears to get through. So I do think that the bulls have some continuation to the upside left in them. The weekly is also looking very good, but myself personally, you guys know me, I'm greedy, especially in the market environment right now. If we do pull back right here into maybe the 28s, mid 27s, I'll probably be writing short puts in the $26 to $25 range, the lower end of our support bound back here, and which was a big contested weekly level from the entire portion of 2024 thus far. So this is where I want to be basing some of my short put trades for the near term future. So that is pretty much everything in terms of our stocks. Now let's jump right into my portfolio. Going to spend maybe 3-4 minutes on that, guys. Not much more than that, because that wasn't that many more trades. All right, guys, so taking a look at the portfolio. Before we go over to some of the positions I added, let's go over a few of the positions that I've closed since yesterday. So in terms of the positions closed, you can see that we did have a Home Depot put leading into earnings, which we got for about $100, and we were able to close that for only $9 this morning. We pocketed the difference, about $91. Very decent earnings trade, went exactly as planned. Now, we also did another trade intraday today, which we were able to pretty much get in and out of the same day. That was Chipotle. So at the height of the Chipotle sell-off, 10:10 in the morning, guys. I don't often clip the bottoms, but usually when I do clip the bottoms, they turn out to be very juicy trades. So you can see 10:10 in the morning was literally the start of this candle right here. We clipped the absolute bottom of the Chipotle sell-off. At that point in time, hourly oversold conditions were crushed, and I thought that this news would not affect Chipotle's stock price in the long term whatsoever. And apparently the market agreed as it bid up the stock price thereafter. So we went in very light. I arguably could have went in a little bit heavier, but you kind of never know with these things. They can last for a few more days, right? So we went very conservative with the Chipotle $45 puts. At that point, the stock was down to pretty much $48. 45 would have warranted an additional 6 to 7% sell-off, and I just didn't see Chipotle going down 20% in 1 week because of that CEO news. So moving on down, we wrote 2 puts for about 30 cents at $45, getting our 0.5% minimums, and we were able to close them very shortly thereafter, a few hours later, for about $6. So pretty much, 80% profit on that stock. Very happy with the way that trade played out. Just a very quick intraday play using short puts. Now, those are pretty much the only trades that we closed over the course of the day. Let's see the ones that we added. So we took another play on Cardinal Health. Cardinal Health, we went the 94. They have earnings before the bell tomorrow morning. So we'll see what happens with them. I went with the 94s down here, guys, because it's a very close area of support and it is above the expected move. The expected move on Cardinal Health is about 4.5%. And this 94 level, although it's not quite 2 standard deviations, it is about let's just call it 8.5%. So it's not quite 2 standard deviations, 2 times the expected move, but almost. Usually they perform quite well on their earnings. They don't usually have any nasty earning surprises. And that is a very big area of previous all-time high support, which is current support for the markets too. So we will see how those go. I got about $40 for that one. So we'll see how it goes over the course of the morning tomorrow. Now, in terms of the rest of the positions that we added today, we added 1 Disney 105 call for December 19th, 2025. Where pretty much we have about 15, 16 months of time left on this one. I'm willing to give Disney a chance. I went out of the money just because I didn't want to spend too much money on Disney, guys. You guys know that when I do leap calls, you've seen me do it before on Amazon, on Google, on high quality companies, I always go in the money for 80 deltas because they perform very well and usually move in line with the share price. There's very little extrinsic value on the option to begin with. Out of the money, you always run the risk that it doesn't get there and you run out of time before you really start getting some gains on the contract, right? But in the money calls on Disney at that current price, in the money, 80 deltas at, let's say, $55, $60 down here, they're about $2,500, $3,000. I don't want to spend that much capital on a swing trade on Disney. That is the only reason why I went a bit lighter. Yes, I'm playing the entire recovery story on the stock, but the recovery story is not guaranteed, right? It is still somewhat of a speculative trade. So 105 is pretty much up here. I'm not asking for too much over the next 16, 18 months of trading, but at least we have a little bit of a position right there. You can see I've started to add small on Disney down here, guys. Only 10 shares running right now and one leap call for just under $600. Got some pretty good pricing on this. So we will see how this one goes. Total exposure on Disney right now, about $1,500. And that's kind of where I want to keep it. $1,500, $2,000 on a Disney swing trade. That seems adequate to me. Now, we also went with some Dollar Tree puts. So I saw these pretty much, going over stocks that I wanted to run the put wheel this morning after scanning for opportunities, and I found this one, guys. So Dollar Tree, $86 puts for about 32 cents, not quite 0.5%, but is quite conservative nevertheless. Dollar Tree coming into a big level of support down here, this big green box. And you can see from the current share price right now of about 92.5, right? To get down to 86, we would need another drop off of 6.5%. I'm not saying it can't happen, but it is kind of unlikely at this point, right? So we will see what happens for Dollar Tree, whether we get assigned or not. But if I do get assigned, we will be getting assigned into daily oversold conditions. And I always look for this because usually daily oversold plus a big level of weekly support that we're coming into could be a nice recipe for a bounce. So if ever we do get assigned, the bounce is probably coming short thereafter. So that is the trade logic behind that one. In terms of the rest here, guys, not much else has changed in the portfolio. I'm trying to see if I did add any other shares. I didn't really add any other shares. Oh, I closed another position, guys. I closed SMCI. It was just a quick swing trade that it took for earnings. I've been in this one for maybe 4 or 5 days. I know I could have probably waited for more on it, but you can see the trades right here, right? So we bought, here's the trades right here. We bought 2 shares as of most recently at about $530.50, and we sold them for $573.5. Total ROI, guys, is about just under 8% in 5 days worth of trading. The dollar amount of gains is not what you should be focused on. It is the ROI, because ROI you can scale, right? I can always go with more shares. The reason I take these smaller trades, guys, is just to show you that even with small positions, you can generate good ROIs if you know how to pick decent levels on these companies for some swing trades. We closed SMCI. Other than that, guys, we just have a few other positions new. So we went with some new earnings plays. 5 contracts at 11.5. We got 9 cents minus commission, so about 8 cents each. And we went with a $12 strike. Only one of them filled at $20 each. So we should be getting a very nice net credit or a nice payout tomorrow. Just about $60 we're going to get paid on these. So very happy with the way these played out. We also went with the OXY $56 puts. These were on the top 5 options plays. So OXY, I'll just do a quick recap from the top 5 options plays video. It is this massive area of support down here. 56 is the start of that support area. So I saw the opportunity present itself early on in the morning and I took it. We got about 21 cents. Keep in mind though, there was only 3 days of trading left. So normal, we don't get the full 0.5%, but decent premium on an ROI basis. And we also went with some Charles Schwab. Charles Schwab, we went with the 59s. Just playing some more defensive companies this week. 59s, I like this one a lot. As a matter of fact, it is pretty much the lower end of this massive band of support that we're operating in right now. And we got some decent pricing, guys. At the time that I wrote it, right, we were getting pretty good pricing. And to get all the way to 59 from current price, that's a decent sell-off. You'd need a sell-off of about 5.7% for a financial stock. I know Schwab has had some bad days in the past, but usually it doesn't move that much. So I thought there was some mispricing in the contracts right here. We got 26 cents. It says that they closed at 35, but this is kind of an anomaly. As a matter of fact, they actually closed around 15 cents. We're actually profitable on this one. And that's pretty much it, guys. Still have the SoFi contracts we got yesterday as well. So all in all, very light week of trading. You can see no massive positions just yet. I'm going to wait for CPI tomorrow, and then maybe after CPI, I'll take some more positions on maybe something like an NVIDIA or Microsoft and start using up some of that buying power that we've been really keeping on the side this week just because of so much macro news events, right? So that's pretty much everything we had for the trading today and the video recap today, right? If you enjoyed it, consider dropping a like. I would really appreciate it for the growth of the channel. Also, consider subscribing if you're new. We do these every Monday to Friday after the close. So hopefully I see you back in a future video. And then lastly, guys, if you have any questions at all, stocks, any stocks you want me to look at, technical analysis, options trade, macro discussion about the recession, anything you want, leave it down below in the comments, and I'll get back to you within 24 hours. Take care, guys. Hope you have a great day of trading tomorrow. Be careful with that CPI in the event it comes in, less good than expected. And I'll see you tomorrow after the close. Take care and peace.